If you're a business owner and you're keeping money inside your corporation thinking it's tax efficient, there's a very good chance you're losing money every single year. Not because you're doing anything wrong, but because the system is designed that way. If we haven't met, I'm Jed Vito, and I work with business owners and professionals on structuring their capital more efficiently. Not just where to invest, but how money actually flows and grows. Most people think incorporation solves the tax problem, and it does at the start. You earn income inside your corporation, and instead of paying 45 to 50% personally, you're paying closer to 10 to 12%. That's the advantage. But that only applies after business income. The moment you take that money and invest it inside your corporation in stocks, mutual funds, GICs, rental income, now you've entered a completely different tax system. Now you're paying around 50% tax of that investment income every dollar. Once your passive income crosses $50,000, you start losing your small business tax advantage, meaning your future income and future business income gets taxed higher too. So, what started as a tax efficient structure quietly becomes a tax drag. So, how do I store and deploy capital without triggering unnecessary tax? That's the shift. Now, let's look at this. This is just from one insurance company. Over 3,600 policies in a single year. Over 17,000 people putting in 10 to 25,000 annually, and over 400 putting 100,000 to 250,000 per year. 60 putting half a million to 1 million in premiums. And that's over 40 cases of $1 million premiums per year. The whole market is probably different, a dozen of different insurance companies. So ask yourself, do you think these people didn't look at real estate, stocks, or private deals? Or do they know something about structure that most people don't? In Canada alone, corporate life insurance holds tens of billions in assets. This isn't a fringe strategy. Institutions and high level operators use this quietly. This is where corporate owned participating whole life insurance comes in. And I want to be clear, this is not about buying insurance. This is about building a capital system. Inside the structure, your capital grows, tax sheltered. It doesn't trigger any passive income rules, and it remains accessible. Instead of pulling money out and triggering tax, you borrow against the policy. Your capital stays intact, you don't pay any tax, and it continues to compound, and you still have liquidity to use. Most strategies force a trade off. You use the money, compounding stops. This is one of the few structures where you use the money and it keeps on growing. Most business owners in retirement pull money out as dividends or salary and lose 30 to 50% in tax. But if structured properly, you can access capital through lending instead of triggering taxable income. And at death, the majority of the proceeds flow into your capital dividend account and can be paid out tax free. So, this isn't about chasing returns, it's about eliminating unnecessary tax drag, keeping your control of your capital, and building something that compounds properly over time. If you're a business owner and you're not structuring this properly, you're leaving a significant amount of money on the table quietly every year. If we already spoken, this is where we take your numbers and map this out properly. And if you're new, there's a link below to book a call. We'll walk through it step by step and see if this actually makes sense for you.